Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, December 18th, 2018. In this video, I wanted to do something a little bit different. I've done quite a bit of updates on the market recently, including a market wrap yesterday, so I'm not going to spend a lot of time talking about the current technical posture of the market or the outlook, but I do want to go over a few things and make some comparisons to where we're at right now and to some of the things that happened back in 2008. I should say from the 2007 to 2009 bear market. Um, I've just to make very clear, nothing at all has changed my longer term outlook. The markets have had a lot of technical damage inflicted. We're over 10 years into well past the norm, the average length of a bull market, the average length of an economic expansion. So I continue to believe there's a very good chance that a new bear market has started. Although I have to reiterate, at this point, the S&P 500 is only down about 10% or so we're, from the highs right now. So we're a little more than that, but not much. So we're technically only in correction territory right now. But again, that's semantics. There's a lot of things that I've covered recently. Major trend line breaks, trend indicators rolling over, things like that that indicate there's a very good chance, well over 50% in my opinion, that this is probably the early stage of a new bear market. Um, Now, I want to say this too, real quick, talk because we're going to look at the previous bear market, and I've said this before for over a year now. I think the next bear market will be very different from the last one. The last one we had a meltdown, the banking system almost collapsed, so the banks went down. There was a swoon. In market cycles. And so I'm going to caution you too when we look at 2007, 8, 9, what happened. Market cycles are a lot like the relationships that you've had in your life, whether it's girlfriend, boyfriend, spouses, your children, your siblings. They're all different. They're always different. No two are the same. So I want to just caution a little bit on trying to say, that point. Well, okay, here we were in 2007 or 2008, and this is where we are now, and this is what's going to happen. So we can expect the same drop. That sometimes you have some patterns and similarities there, but they will be different. My expectation is the next bear market, whether it's already begun or not, will be a much more prolonged, drawn out bear market, and it'll have plenty of opportunities for swing trading, both long and short, catching the major trends. And that's one reason I'm doing this video. I made it very clear that back earlier this year, sometime around summer, that I had gotten reached a point where I've taken all the long-term funds I have, 401k money, stuff that I can't actively trade, IRA accounts. IRAs, I can do a little more flexibility there, but as far as 401ks, I use an example. My wife has a big 401k. I don't. I'm self-employed, so I have a SEP plan for myself. But as far as that goes, there's no shorting available. You have the typical run-of-the-mill options, and I know a lot of people just about everybody listening to this video probably has a 401k or something similar. So you have your U.S. stock funds, domestic, international, small, mid, large caps, stocks. Of course, those are all stocks. You have usually an option of bonds, whether it's treasury bond fund, corporate bonds, and then money market funds. Most 401ks don't have a commodity fund. Most 401ks don't allow you to short. So therefore, the most effective way to navigate a bear market is, for the most part, cash. But we've had tactical trades, and I've talked about this in the past. I don't want to get off topic here, but I use, tactical asset allocation. We've traded in the last couple months here. We've had longs on gold and treasuries. Both, closed the treasury trade out profitable recently. Still long gold right now. May close that one out soon, because even though they weren't participating right away, I expected they'd be able to catch a flight to safety bid, which they finally had. Once everybody realized, hey, this wasn't just a little pullback, then treasuries and gold stopped ignoring the weakness in the market. So what I'm getting at is we'll continue to do that. So you can, you don't have to short during a bear market. There's always opportunities to make money. But the big ones come, just about everybody has access to equity funds, and so I mentioned on Friday for the first time in many months, moving money back into the equity markets, starting to scale in, and I'll continue to do so. I made a second transfer yesterday, and I'll continue to do it, and that's why I'm doing this video. So let's dive into the charts here. So the bigger picture, just to wrap up where we are, and before we jump back to the previous bear market, is all along, even as we're working our way up here, heading up into the highs, my expectation was a pullback, give or take, somewhere around these 2018 earlier lows, and that's what happened yesterday. We almost hit, very close to the February low there, so we undercut that low, the second low. And that's a pretty decent support level. To try to put this in perspective before we move on, or gauge my thought process. And I've been saying this all along. We're up here. I was talking 10% more downside. As the lower we got, my downside it decreased. The higher we got, the higher my downside expectation got. So at this point, where we were, we'll just go from where we were yesterday. This is my what I call my cone of certainty. We'll just call that my expected drop. So what I'm trying to get at is I think anywhere from where we were yesterday, and what I'm referring to is before a decent rally, whether you want to call it a bear market rally or anything you want. It's technically not a bear market rally until we have a bear market, meaning a drop of 20% or more off the highs. So it's all semantics. Let's forget about the terminology. Let's just talk about the charts. I'm looking for a rally that will probably be double digits, low double digits, but I would say minimum 8%, more likely 10, 12, maybe 15%. And I think that rally begins anywhere from about where we closed the lows yesterday down to about maybe 2% on the SPY. And I would give it about a 70% degree of confidence that that window is there from anywhere from yesterday's lows down to about 2, probably no more than 3%, maybe a little bit more on QQQ. We'll get to that in just one second here. And when it starts, that's a little more difficult, but I think soon. I think we'll probably get some type of, if you see the Fed backing off, continuing to back off their previously hawkish stance. They've been moving to a more dovish stance. Either way, even if it's just they come out and they say nothing, that's what they tend to do. Oh, well, we'll react to the data as it comes. They'll probably speak a more dovish tone. But once the FOMC meeting's out of the way, that'll probably clear the path to rally. From my experience, nothing much happens. The markets kind of flounder around in front of a FOMC meeting. So I don't expect much to happen between now and 2 o'clock tomorrow. Relatively speaking, keep in mind, these markets have been swinging up and down 2-3% plus a day. So when I say, I don't expect them to hold flat, there'll be some volatility for sure. But best to wait till the FOMC meeting's out of the way and not jump on the initial reaction tomorrow. So here it is. So we have the divergent low. It is still unconfirmed, as I always say. There's a couple things it's just me. This is for when I'm looking at divergences. I like to see. I consider this unconfirmed divergence. I like to see a bullish crossover. That means when the signal line, that orange line there, crosses above the PPO line, and that will confirm the divergence. Why is it unconfirmed in my opinion? Because right now the momentum is still down. This is a momentum indicator. Both these lines are pointing lower. That's because the momentum is to the downside now. And what does that mean? Well, if they continue lower, guess what? Once you undercut this low, you no longer have positive divergence. RSI is ticking up a little bit. I do expect it. I also say this, and this is very important. I've said it many times. Divergences in themselves are not a buy signal or sell signal if they're negative divergences. Far from it. We did have negative divergences at the high here, but the thing about negative divergences is they can build for a while. You had it at this point here, and the market kept moving up. And finally, they played out on the high there was September 20th, I believe. That marked the high in the S&P. But so divergences are not a buy signal. However, once they're confirmed, and they work much more often than not. I would say, and this is just from experience, I haven't calculated these numbers, but I would say well over 90% of the time when you have a confirmed divergent high or divergent low, that plays out for a meaningful trend reversal. Meaningful means something you can trade, something lasting it's also commensurate to the time frame here. If I have a 15-minute chart with bullish divergence, that's good for a trade for a few days. If I have divergence on the daily time frame, which we have here, once it's confirmed, I would expect a rally lasting at least 3 weeks, possibly months. And it also depends on market conditions. If it's a bear market rally, I'm looking for a lot shorter um, smaller gains and a shorter duration on what I expect to be a bear market rally. Even though, again, we can't label it as such right now, but that's my take. I'm treating this any rallies coming up as a bear market rally because of the overwhelming evidence that I've seen in the charts and everything else I've covered in the past. So that's it. So if I had this divergence in, back in 2010, great position, get in long and plan to tuck those longs away. You can ride them out for many months, maybe even a year or more, until you have the next sell signals. So just to summarize, we fall into what I believe to be a very decent, solid support zone with bullish divergence. That gives me a heads up that an impending trend change or a rally is very likely. Nothing is guaranteed. I still can't rule out the meltdown scenario I talked about a few weeks back, but this is I'm going off the charts. I know everybody's becoming increasingly bearish now. I've even seen comments on the YouTube channel that wow, Randy, you really pulled a 180. I was calling when we were here, selling for more downside, and now that we've got that downside again, I'm just looking for a rally, and this also helps confirm that, not just the divergence on the daily time frame. Here's the 60-minute charts. So we have right now what I refer to as the charts being stacked. What I mean by that, well, we have divergence on the daily, and that's been building for a while. I've pointed it out. Only recently, when SPY made undercut that previous low right here, did we have the daily divergence, and we had a little pop, and now we've gone lower. And we can continue to work lower. We may do that, and these divergences may continue to build. However, there are divergences in place now, and because we have this divergence also forming on the 60-minute chart, if we can rally a little bit more here in the next day or so, I really want to see us get above 263. I think that's an important support level. I mentioned it was a roughly triple bottom low. We just undercut it recently. If we get back above there and we do it soon, that will confirm the 60-minute divergence because the charts are stacked. So if this is confirmed and that opens a door for more upside, a rally, what it does, it carries over to the daily chart and we'll start turning this PPO up and then giving us confirmed divergence here on the daily chart, setting the stage for a much larger rally than what 60-minute divergence might normally give us. What does that mean? Well, last time we had 60-minute divergence, I pointed it out at the time, was right here, and the S&P 500 rallied about 8% in very short order. So therefore, there's a potential for more than that off the lows here. We could easily rally back up to that 281 level, probably pop it too. I guess it's been tested so many times, and I'll just say this now, not to get ahead of myself. If and when that happens, if you don't hear from me in 3 weeks, 4 weeks, 2 months, 3 months from now, and we're rallying up there, we've gone lower, whether we've gone lower or not, everybody's going to be getting super bullish at that time, saying, wow, that was just a correction, just like they're super bearish now, and you just can't fall into that unless the charts are telling you something different. But just keep that in mind. So we'll have to. I don't want to get off topic here too much, and we'll talk about whatever rally once it starts to materialize. Then we'll look at the charts and see how far it might go. And where the objective shorting ops will be. Here's QQQ, same story, 60-minute charts. We had a divergent low right here. That divergence led to a rally of about almost 10%. This is the first time since then we've had bullish divergence here on the 60-minute chart, and you have this little wedge type pattern. So again, there's plenty of potential. And when we go out to the daily chart, you also have divergent. You had a divergent low right here on the daily, and it led to that 10% or so rally. And we have just an extension of those existing divergences. Okay, now let's zoom over. Let's take a little trip back in time, and let's go look at 2007 to 2009. So that's what we're looking at here. Just like this rally I told you, or this well, we'll see. Time will tell. But this bull market, or at least the recent top in SPY, I said it was back, I think, September 20th. But QQQ put in roughly an equal high from its August high. It did a equal high back in October 1st. And just like back here, the bear market in 2007 began in October. So that was the official end of the last bull market there in October, early October 2007. And you can see what happened since then. It was I think about a 55% drop in the S&P 500. So what we're going to do here is show you what this bear market looked like as far as divergences. And so what I need to do is annotate the chart. Now this is stockcharts.com. It's a very clunky, antiquated charting platform. I keep a membership there, a subscription, just because you can do this. I can do things I can't do with the TC2000 charting platform that I'm usually using in the videos. So what I've done here again is I plugged in a certain time frame, and we're going to look at just draw out the divergences. Let me do this quickly. I'll grab a trend line. Let's make it blue so it stands out. And I'm just going to take a quick look here. I can see a divergent low right there. There's positive divergence. And again, that's after the top was in. I can see divergence here. There's a strong, very powerful divergence. And let's draw prices making lower lows. And those divergences were extended from that same point. And that's quite often we see this as well. You'll see a divergent high or low followed by a second even larger divergent high or low. And that marked, by the way, the bottom. So just if I didn't make that clear, this was the top of the end of the last bear market, or the beginning of the last bear market, and the end right there in early March. And again, that's about a 55% drop. Doesn't look like much because I used log scaling on the chart, but it was. All right. So before I leave here, let's just do one more thing. Let's just look at the divergent highs. We have there's not many, but I do want to point them out. All right, so let's see. Let's take those off. Use this trendline tool. I see one right here. It's small, but definitely the PPO is making a lower low with prices making a higher high. And I see right about here an almost divergence. I'm going to use a dotted line for this because prices made a slightly lower high. It was almost an equal high right there, but you can see the PPO and the RSI down here making lower highs. And so the two takeaways from this. Number one is that I've heard people say, oh, divergences don't work in bear markets, only bull markets. No, that's not true. They do work. In fact, we'll measure these out here in a second. But the takeaway is it doesn't take much. Once a trend has changed, just like during the bull market for the last 10 years, if you got any type of divergent low on the S&P or QQQ, NASDAQ 100, even a small divergence, it led to huge rallies that would go on for months and sometimes years because the primary trend was up. So the point being, in a bear market, you usually don't get divergent highs. When you get them, they're great because they signal a top in the next big wave down. So again, you didn't get many. Let's not spend too much time on those. Let's look at these divergent lows. Now let's measure this out. So we had really 1, 2, 3 divergent lows. And I need to take a measuring tool here, and let's color this a little different. There we go. So from low to high right there, we had a rally of better than 15%, about 15.5, 16%. We had this strong divergent low. There was a flush out move in November, put in strong bullish divergence, and from that low to the high, we rallied about almost 29%. And then the bear market ended with a big, strong divergent low back in March. We can't even measure it, at least not on here. It'd have to go. It's 400 or 500%, whatever the S&P went up. So that showed you, okay, even during one of the worst bear markets in history, you had opportunities to make well into the double digits, about 15, 16%, 28, 29%, and then of course mark the rally. So you don't get them often, and that's why I'm doing this video. We have a divergent low right now. I think it's worth paying attention to. And in fact, again, we're not even officially in a bear market yet, but that doesn't matter. We're at support with bullish divergence, and they do work in bull or bear markets. And so I just wanted to share that. One more thing before we leave this chart. Let's look at the moving averages. Let's close that out. And no, let's not save those changes. Let's go to add a couple moving averages here. We'll do the exponentials. You can use simples, but I like the exponential moving averages. I prefer them in most cases. So we'll do a 50 and a 200 day. That's what I usually have up on the charts that I show you, my daily charts. So we update that. Take a look at this chart. So a couple things that stand out. Back on the top, remember the top was here in October, and then a few months later, just like now, we had a death cross. A death cross is when the faster MA, the 50-day moving average, moves down below the 200. I'm sure you've heard about it. I was talking about before it happened, and I'm sure everybody else has been talking about it recently. A couple things to note, however. We moved down from the time the crossover was made, right about this point here. Prices had already fallen. That big move down gave us a crossover. So this is effectively at the point you had that the crossover, the death cross. You can see what I'm doing here. I'm dragging a line out. So there was a little more downside, and we've seen that in the market recently, another swoon down, and there may be a little more down, like I said, maybe 2-3% downside. But what happened, it wasn't a very effective time to short. You got that signal. So let's say you didn't short right away. You waited till you read about it, and it's been a few days, a week, or even if you shorted there. Here's what happened. From there, we put in a divergent low. Now, we've already done that this time around. I showed you a minute ago when we started the video. We already put in our divergent low. They didn't put theirs into this point here back then. And from there, you rallied right back to that point. So there really wasn't much. There was a little downside initially, and then we had a kickback rally. And again, those divergences played out for that 15-16% correction, or bounce, I should say, that I talked about. The other thing to note is that we got back above, and I mentioned this recently. The markets had dropped below the 50 and 200, and then we had that rally, and all the bulls came out of the woodwork. And I said, you guys, that happened back. I did a video and pointed out that that same thing happened back in 2007 before we had the death cross. We rallied back after falling below the 50 and the 200. We rallied back above it, and that proved to be great shorting up because the markets didn't look back. So a couple things to note. We eventually went on after the death cross. We came back and look at this 50. It's done a great job. And that's why I leave the 50 up and the 200 day. The 50 did a great job as support. Broken, it acts as resistance. Once you're above it, it acts as support. So now if the trend is down, we can look as potentially objective shorting op on the pushbacks to the 50. We push back, failed. Push back again, failed. Finally, we recovered it there. A little sloppy action trading through it, but we recovered it. And then what does the market do? The next run is at that 200. And look at that. It tried to take it out, failed, tried again, got above it a little bit, energized the bulls, I'm sure, when it gets above. But the trend is bearish, and you got to remember that you're going to slice through these EMAs. They don't do a perfect job of containing all the pushbacks, but they do a pretty darn good job. And you can see there. So you had plenty of ops to short at the 200 day. And so that might be something we're looking at now. So we'll see. We'll see how this thing goes on the next bounce, whether it comes today, tomorrow, next week, next month. We'll look at maybe a pullback trade off the 50, but I like to see other things. I like to see confirmation on the intraday charts with trend lines, price, divergences, other things like that. I don't blindly short, or go long on EMAs just because they're there. Sometimes you move right through them. So as you can see, you can get burned on that strategy. But taken with other technicals, it works. And then once this bear market got underway, you can see there was a couple. This is the point where nobody believes it's a bear market. And then once you get down here, this is that point of recognition where just about everybody accepts reality. You're already down over 20%. And so then you get back to business where you had a good time just shorting bounces back to the 50-day moving average until the bear market was over. That's it. All right, so let's see if there's anything else I wanted to cover here. No, that's about it. Anyway, so that to the charts we're looking at, and there's where we're at. You can see I have the EMAs turned down, but we made that bearish cross back here, or actually after a little brief false break above the 50 and 200. Here's the 200-day. I'll turn it up so you can see it a little better. And there's a 50-day. Turn that up. You can see it a little better. So those are. So if we bounce it, we might come up to this 50. The 50's falling, but if we start to rally, it'll start to move back up. So you might hit it around this level, and that alone is about a 6.5% rally. The 200-day is a little above there, about 7%. And again, that rally may come from lower levels. I gave you my downside range on SPY. QQQ still hasn't come down and hit. I have that yellow line at the April lows. We undercut it here, so really you have the February lows right here. And I said it before, you're not going to have perfect tags of those levels. The market's either going to reverse a little above there. On SPY, we effectively hit it yesterday. So on QQQ, I'd say my downside range is a little larger. I'd said about maybe 2% or so on SPY, maybe 3-4%. And again, I would put probably a 70% or better chance that that is the maximum downside before we mount a meaningful rally. And that's, to me, why I don't think shorting here is very objective. Doesn't mean we can't get a meltdown type crash, another 10% drop, 15% drop in the market. Anything is possible. I just don't see it. I don't see it in the financial system right now. I don't see it in the charts. And this is a strategy I'm playing. So it's not I don't have any type of buy signals yet. So I've been scaling into longs, and that's also a function of why we don't have official long trades on the site right now. Many of those, at least equity oriented, because we don't have those buy signals yet, and I can't rule out another 2-3% or more downside right now. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.